Hi everyone. In this video, I'm interviewing Holly Morrow, the Senior Vice President of Knowledge at uAspire, a nonprofit organization helping students find affordable paths to higher education. Today, we're going to answer the question, how do student loans work? Holly, thanks so much for joining.
Thank you.
So let's start with the basics. What is a student loan?
Great question. So there are basically three types of financial aid that a student can apply for, and we'll talk a little bit about the application process in a second. Basically, there's free money, gift aid, which is the best type of financial aid, and there are student loans, which we're going to talk a lot about today, and there is work study where you can get a job on campus and earn money similar to any other regular type of job. In terms of loans, the basics, so a loan is money that has to be paid back. So a student loan is exactly that. It's part of the financial aid offer that the colleges you're applying to will offer you. And then after you graduate college or after you drop below half time, there's a 6-month grace period. And that student loan is money that you are borrowing and that you do need to then pay back once you've graduated or once you have dropped below half time.
Great. So how do students get a student loan?
Yeah, so really important that all students who are applying for financial aid are filling out the FAFSA, and that is the free application for federal student aid. You can find it at fafsa.gov. It's kind of the main gateway for all those different types of financial aid that we just spoke about before. But it is absolutely the first step for being eligible for the different types of student loans that exist. And we'll talk a little bit more about those different types in a bit. The FAFSA is available as of October 1st each year. So if you are a senior right now, the graduating class of 2021, you can fill out your FAFSA right now. If you are junior or younger, you have to wait until October 1st of your senior year. But by filling out the FAFSA, that is the first step in being able to be eligible for the student loan. There are follow-up steps. So after the college has awarded you their financial aid package, and if you have loans part of that offer, in order for you to actually get that loan money to your account, there are some other steps that happen usually the summer before you matriculate into college. So things like the entrance loan counseling, so that you understand your rights and responsibilities as a loan borrower. There's also something called a master promissory note, which basically is you signing something that says you promise to pay it back. So there are some other steps in the process, but first and foremost, the most important thing is for a student to fill out that FAFSA and list all the colleges that they are planning on applying to for that next year.
Great. So what questions should students ask themselves before deciding whether or not to take out a student loan?
Yeah, it's a good question. So, the most important thing that we tell our students is make sure you're applying to a variety of colleges. Ideally, the least amount of loans that you take out is the best, right? So, as I said before, our hope is that most students are able to maximize the gift aid or that free aid and that they don't need to take out too many loans. So, questions that students should be asking themselves is what is the overall cost of attendance for the different colleges I'm applying to? And as a student starts to fill out their financial aid application, such as the FAFSA, they'll get a better understanding of what theirs and their parents' financial situation is. They'll understand what that family's expected family contribution is. And so it's getting down to the point of having a really clear understanding of how much the colleges cost, how much financial aid the student might be eligible for, and then having family conversations basically about what is the family willing to take out in terms of any loan debt. What's really important to note is that there is a maximum in terms of the federal loans that a student can take out each year. So, for example, for a freshman, first year college student, they are able to take out only up to 5,500 in student loans from the federal government. So anything above and beyond that would be a conversation in terms of, is the family willing to take out additional loans? So that might be a question, right, that a student might have. Other questions that students should be asking and understanding is, what is the interest rate for loans? And we could talk a little bit about that in terms of the different types of loans that exist. But really focusing on the federal loans. It's also what are the repayment requirements that that loan offers. And so, again, focusing on the federal side of things, there are a lot of different repayment options that the student will have. And so, those are the types of questions, right? Like, how do I apply? What is the interest rate? How do I repay? When do I have to repay? Those are the types of questions that a student should be asking about any loan, but hopefully they're focusing on those federal loans.
Great. So, what are the different types of federal student loans, and do students get to choose which type of loan they borrow?
Yeah, great question. So for the federal student loans is broken down into the federal direct. Sometimes you'll hear different terminology for the different loans and sometimes some antiquated language, but it is technically called the federal direct subsidized loan and then the federal direct unsubsidized loan. So the subsidized loan, what that means basically is it's available to students who have financial need, so demonstrated need based upon the financial information that's reported onto the FAFSA. And so if you do have need, then you're eligible for this subsidized portion of the federal direct loan. And subsidized is just a fancy word, how I explain it, at least to say that the government is going to pay for or cover the interest on that loan while you're in college. So the interest is not growing or accruing. And the maximum amount that a student can get in terms of that, it changes each year. For freshman students, it's $3,500, and then it kind of goes up each year that the student is in college. So that's the subsidized portion of the direct loan. And then there's also an unsubsidized portion of the direct loan as well. And so for freshman students, they can get an additional $2,000 of unsubsidized federal direct loan. And that unsub means that a bit of interest starts accruing on that loan. Right now, loan interest rates are very low. I've been doing this for a long time, and they're at the lowest they've been in, at least during my time working within financial aid. So current college students right now, their interest rate for the direct subsidized and unsubsidized is 2.75%. It gets reset each summer. And so if you're a high school senior right now and you're just filling out the FAFSA for the 21-22 college year, you'll find out what that interest rate is come this summer, and hopefully it will not be increasing. Hopefully it'll stay at that amount. So all that combined together makes it about, for first year college students, a maximum of 5,500 for the student for that direct federal loan. There are other federal loans that potentially parents can apply to take out, and that is something called the plus loan. But really important to remember that there are limits for students in terms of how much they can take out each year in their name. So really important family conversation to have early on is to just be open and honest and to see, are parents willing to apply for and take out loans on behalf of the student's education, but that loan would be in the parent's name only.
Great. So, what are private student loans, and when should students consider taking out private student loans?
Yeah, so private loans are additional loans that are offered by a wide variety of other entities outside of the federal government, right? So you can have your local bank might have a private loan. You can look online and you can find different companies such as Sally Mae, for example. You might have seen a lot of advertisements right now for SoFi. So those are just examples of other lenders, and that's a private loan. So you have your federal loans, everything that we just talked about, and then the private loans. So the federal loans will actually be listed when they fill out their FAFSA and once they get their financial aid offer letter from the colleges. It'll be listed from the college because they're the direct lender of that federal money. The private loans, if a student, say, for example, has a gap, right, or has an estimated bill left over after the college has awarded them their financial aid, yet the cost of attendance was greater than that amount of aid awarded, whatever's left over is going to be what the student has to come up with out of pocket, if you will, or their estimated bill. And so sometimes students will turn to look at private loans to help cover that, and they would have to apply for that separately. It is a completely separate process from the FAFSA. Here at uAspire, we really recommend that students exhaust those federal loans first and potentially have that conversation, as I said, with their parents around the federal plus loan before they start looking at those private lenders. So, not saying private loans are bad, but we just want to make sure students are taking advantage of low interest rates, multiple repayment options that the federal government has. Also, to note, during the times that we find ourselves in right now, there another positive to the federal loan versus the private loan was that the federal loans, in terms of repayment, were stopped during the COVID pandemic, and there were a lot of kind of allowances given in terms of stopping interest to be accrued, things like that, that we didn't see from the private side. So again, exhaust all federal loans. That's our recommendation at uAspire, before you start looking at those private loans. If you do need to look for private loans, typically they're going to be asking, for you to fill out an application. Typically the rates are going to be dependent upon credit scores. Typically for students, they are going to have to find a cosigner to go along with that private loan. So there's a lot of other steps that would be required if a student does go down the path of looking at private lenders.
Great. So students should know which federal student loan repayment options to choose. There are a lot of them, but can you go through a couple of the best ones and potentially some that students should avoid as well?
Yeah. So, as I mentioned earlier on, that one of the follow up steps, if you do end up taking out a federal student loan, is that you do have to go through entrance counseling. And so, what that student loan entrance counseling is that it's basically going to educate you on your loan, and it's going to start to look into the future and explain to you what those different types of repayment options are. So, there's a standard 10-year repayment option that some folks take out. What's great though is that there's a lot of other income-based repayment options that are out there. And so what that means basically is it's not going to say, okay, regardless of how much you make, this is what you have to pay every month. That's a standard payment. But the income-based repayment plans are going to look at how much money you're actually earning in your current job. And you're going to pay a certain percentage of that amount as you repay this loan. And so, uAspire, we really recommend those. We think it sets the students up for the best success based upon how much income they're bringing in. It just makes sense to us, right? That the amount that they would have to pay back is based upon that income. The more money you're able to make in your income, then the more you can start to pay back your loans. But the expectation is set to kind of that ratio of how much you're earning before they're saying how much you have to pay. Also, if you go into a certain field of work, there is loan forgiveness. So that is also something if you're doing public service type of work. So depending upon your major, that's something you can also take a look at when it comes to federal loans. And there's some great programs that are out there in terms of loan forgiveness as well.
Great. So finally, what should people do if they can't make their student loan payments after they graduate? What are their options?
Yeah, really important point here is once the student does graduate, or if they drop below half time and their loans get kicked into repayment and they're having trouble making those payments, the most important thing to do is to communicate with the student's loan servicer. So once you take out that loan, and actually when you start to go through that entrance loan counseling and things like that, you'll know who your loan servicer is. So it's basically the person that you would reach out to if you're having any issues, and you can let them know if you're having a hardship, right? So let's use, today's day and age right now. Say you were a student, you were employed, you're making your monthly payment as set up via your payment plan, and due to COVID, you lost your job. Then you would call your loan servicer, explain this hardship, a job loss, and they would work you through what the next steps are. So the next steps might be a wide variety of things, and each servicer is going to work with each student differently. But the most important thing would be to make sure the servicer knows what's going on and over communicate as possible about that situation so that they're in the know about everything that is happening. That's the best thing a student can do if they're unable to make those payments.
Great. Well, thanks, Holly, for joining us today.
Thank you so much.
If you like this video, please give it a thumbs up. And for more interviews like it, please subscribe. Have a great day, everyone.